There's a lot going on. A lot's changed. I'm going to cover a lot of things today. So it's probably going to be more like 45 minutes instead of the usual 25 to 30. Um, there's a huge shift that's happened almost in a week, even though we've talked about a regime shift since early December, starting with inflation surprising and starting to see weakness in tech and higher valued names. Got into the beginning of the new year. We saw a continuation of it with Europe and China doing well and outperforming the US. But over the course of the last 2 weeks in particular, but I would say 4 weeks, once the tariffs started to come in and people didn't believe they were going to happen, I didn't believe that they would be willing to sacrifice the stock market. That's what's changed. So as we go through this, the first line, there will be pain and no Trump, and you can't see it here, it says put. So no Trump put. Stocks break down on the back of that. Zelensky's Oval Office meeting fallout is something that I'm not hearing a lot of people talk about, but it had a huge impact on the markets this week, and in particular, after I get through the recession fears rising, hedge fund deleveraging. The market is repositioning for a very different world that they envisioned as of December. And that's what's really been, I would say, the major story of the week. And then I'll go through something that just isn't getting a lot of press at this point because I think people are hoping there'd just be an announcement to buy. But the Strategic Bitcoin Reserve with the summit at the White House went on. So I'll go through all of that. But to start, I have joined 22V to provide deep dive research. Nothing's going to change with the video. Nothing's going to change with my Substack. I'm still going to do those. But through 22V, if anyone's interested, they can reach out to them. I will be doing deep dive research focused on the impact of AI on macroeconomics and ways to invest in it. I'll also probably be doing some other things on there eventually, more geared towards the trading side. But for now, if you're an institution or if you want to work with them, give them a call. I've known them a long time. They're great guys. Secondly, Anthony Pompliano and I started doing a weekly kind of recap just on what's happened from our perspective. Anthony and I both believe this is a huge year with the administration taking over for Bitcoin. But my view, again, as I've said to you, is that this is the beginning of a massive transition away from what has been a dominant theme in technology, and specifically the Mag 7, and that the combination of AI as a disruption to the adoption phase, where it's going to be a disruption to centralized stocks, centralized locations, and I believe we're seeing that, and that's one of the reasons why we're seeing the U.S. underperform. I think this will continue, and I think the Mag 7 is going to have a hard time. At the same time, we're starting to see another thing that I believe that would happen, which is I believe we're in the beginning of a very large and significant change in hedge fund investing, and I'll go through a lot of the reasons why here. But again, this is an AI disruption, and what you're going to be left with at the end of the year is a new alternative and a new high beta investment, which is going to be Bitcoin. So Bitcoin is going to be the end result this year. I believe for those people that are looking for an entry point, as I go through this, I really think we're at it now. I highlighted last week some divergences from a technical basis. So Anthony and I will be doing that each week. It'll get dropped on Saturday. I highly recommend you go through it. He's a great guy, but more importantly, between the two of us, I think we're a good combination of kind of looking at the markets and talking about things. He's obviously completely connected into the crypto space. I'm more so from the macroeconomic space. It's a good bridging, and for those people looking to learn more about crypto or macroeconomics that are more focused on crypto, I think it's a great bridging. All right, so quickly, U.S. markets down. NASDAQ is now down 6% year-to-date. S&P is down 2%, and you can see the rest of the globe. Hang Seng up 21, Europe up between 10 and 15. This divergence, again, is more about people repositioning. And what you can see here is bond yields. This is 10-year yields this year. You can see that for the week, look at these movements in terms of 10-year bond yields, for 3 months versus the U.S. So U.S. 3-month change in yields are up 10 basis points, and they're below the midpoint of the range. Europe, all on the highest they've been, and they're up between 68, 84, depending on which one you look at. It's a big shift that's happening. There's a reason for it, and I'll go through it. This is really the big story. So at what would be the address before Congress, He tells America that tariffs are worth the economic pain. So he's basically telling everyone he's going to do tariffs. Besson came out, and I've never seen this before, but he said there is no Trump put, warning that the markets are going to be hit, and that's part of what they're doing. He also said tariff policy can finance income tax and income gains for the bottom 50% of wage earners. This is a major theme that comes out. Think of it as Main Street versus Wall Street. I'll get into a lot more of that. Newt Gingrich, Trump is really increasingly convinced of the McKinley model. High tariffs lead to massive capital investments, leading to high-paying jobs. I don't agree with this, but it doesn't matter. You're in here regardless of what you believe should be done or should not be done. We are here to make money. We are here to invest, and I think this is a dramatic shift on what had been going on. And again, Besson, it's a focus on Main Street. Wall Street's done great. Wall Street can continue to do fine, but we have a focus on small business and consumers. We are going to rebalance the economy. Short-term pain is their plan. So I just want to highlight what they're trying to do and give you a perspective. So the budget deficit, or the fiscal deficit you've heard, is down around 6.5% to 7%. That means we're funding the government with excess debt. We have a debt problem, so they're trying to get this back to zero. This is the big thing. Ray Dalio is out there saying if they don't get it back there within the next 3 years, there's going to be huge problems. I think he said a heart attack for the market. The problem with that is we have an issue here of how big the debt is. So that they don't want this going any higher. But my problem is when you're trying to fix the deficit and you're saying you want the stock market to go down, I just want you to highlight, because people keep bringing up that this is going to be Reaganomics 2.0. To some degree, you're following it with the deregulation, but this was a very different scenario in 1982 in terms of where debt to GDP was. So Reagan actually took advantage of the fact that he could spend, and he was spending. They're trying a different method with it up here, and they're using austerity, whether it's through the form of getting rid of federal workers, Elon Musk trying to find ways not to spend. We have a spending problem, which means austerity. It's very dangerous when you have debt to GDP at this level to try austerity. It's not an easy thing to get out of, and part of the reason is because of this. So in 1982, here's the other thing that was different. This is where the stock market cap relative to GDP was. It was down at 40%. It's now up at 200%. This is the total value of the stock market over GDP. So back here, we were at around 40%. To give you an idea, Germany right now, which is ripping, is at about 60%. We're at 200%, which means our market, our economy, has become the stock market. This is house prices overlaid with the S&P 500. So if the S&P 500, if they're willing to make this come down here as part of the pain, the housing market's going to follow. There's just no other way around it. It's not going to sit there and go higher. I think it's going to have an impact on jobs too. But they want it lower because of this. Home price to median household income back in 1982, again, it was around 4-to-1. Now we're up here. This is where the housing bubble was. So people can't afford housing. So the attempt makes sense, and I don't think it's going to be able to work. If the stock market goes down, I'm fairly certain of it. They're going to try to navigate this and thread it. But here's what he said. The market and the economy have become hooked, become addicted to excess government spending, and there's going to be a detox period. The government is telling you to be careful in the market. So this is a very different situation than we've seen in the market. And the only thing I can compare it to is back here. This is back in 2022. Jerome Powell, right here, gave a speech where he told the market there will be pain. He wants the unemployment rate to go higher. And the market proceeded to fall 17% after he said that. In this case, you had a rally beforehand. This time where Trump said this, the market has already fallen. So as I go through this, we hit support here on the 200-day moving average. We had a nice reversal day on Friday. I do think we're going to get a bounce here in the market purely because the sentiment has got so done. And at least now they've told everyone there's going to be pain. So at this point, it's no longer a surprise. So a bounce just to screw people because I think it will hurt people as I go through the hedge fund component. So that's it. In terms of the MACD, this is as ugly as it gets. I think we're going to continue to see a sell-off in the market. I'm going to guess we're going to come somewhere into this area before we're completely done. It could overshoot, in my opinion, and get down here. But a lot of that depends on the tariffs. He still has been showing signs of not wanting to do too much damage. So you got to play the game based on what's going on. As long as tariffs are in place, until we can get through this and the economy can adjust, I think it's going to be difficult. They want rates lower, they're getting it. They want oil lower, they've gotten it. The dollar's lower, I think they want that, they've gotten that. So there's some positives going on, and I've said this before, I am not worried about a recession. I think AI and AI agents are the story. They're taking a risk at this time, which I think they want, but I think the closer we get to the midterms, the harder it is to do this. So I think they need the maximum amount of pain in the first 3 to 6 months if that's truly what they're trying to do. In terms of the Mag 7, I just wanted to highlight this. So the Mag 7, this arrow here is that we have this 125 exponential moving average turning down for the first time since back here. So we are at a point now where I would expect, again, a bounce in the Mag 7. But as I've said before, the Mag 7 to me is going to be the major story for this year. I think it's going to underperform the market as a whole. I definitely think it's going to underperform Bitcoin. I think this looks very toppy here, and I think you could get down to lower levels in this area. If you break this, I think it's going to take a long time for it to go back higher. I don't think this is the place to go buy for some big beta bounce or anything. So I think that is a problem. The Mag 7 has started a trend change, and at a minimum, I think it'll underperform. But without them going higher, the best case the S&P can do is again choppy sideways for the beginning of the year, and then if we get through and we find enough let's say spending cuts and the economy's still okay, then I think we can start looking through it after about 3 to 6 months. But I think we've kind of decided in the market that as long as the government's going to talk things down, it's a problem. I mentioned Zelensky. So he left the Oval Office, and then over the weekend, we got a massive move on the EU. The EU will spend billions more on defense. It's a powerful statement, won't do much for Ukraine, but it does a lot for changing the markets. So Germany immediately shocks markets by unleashing billions. This is super important for the markets. Here's what the defense index has done in Europe. Shocking, just dramatic move. And this is back to 1990. This is all the data we have on German bunds, 10-year bunds. We had a jump of 1 day of 29 basis points, the largest in history. This is a VAR shock. There is no way that this didn't take out some people in terms of hedge funds. This was another event on top of so you got to think about the autopsy, as I'm calling it, for the hedge fund unwind trade. When momentum starts to turn, when it's been working for a while, then it starts getting people to adjust. Then you start getting all these little events. There was an announcement over the weekend about large losses at one of the larger hedge funds. You start getting these little things which cause deleveraging, and because we have so much money managed, as I tweeted this week, in an AI optimized manner, you start getting these VAR shocks one by one, especially when you get something like U.S. growth, which was supposed to be good, and the government saying we don't want it to be good. We're willing to sacrifice short-term growth for long-term gain. Well, then the market has to adjust. When you add in that now Europe, the tightest purse strings in the world, have decided to spend a lot of money, you get this dramatic shift. So the losses that are out there, I'm sure, for vol sellers and everything happen. This is going back and looking at when we started these conversations was right here. This is the way it works for momentum. You kind of get the volatility's been rising, and then all of a sudden you get this puke down. We've now broken the trend line as of Friday for pure momentum. Everything has shifted. So people have to reposition, and there's just not enough liquidity in the market relative to how big the leverage was, and I'll go through that as we go on. This is the sector momentums. You finally got the consumer discretionary to join all the other ones. So you've got the pure momentum. The blue one here is the TMT. You can see how much this went down. They tried to get it back up around NVIDIA, and now it's collapsed back down. The red one is healthcare, which had been in trouble all year, but you've had momentum breaking down. A lot of talk going around, and I thought this was interesting because the market is only down 6% from its highs, and yet there's a lot of people calling me, going through it, saying what's going on. This has always been my specialty. I love factors. I love looking under, but I managed a hedge fund for a long time and a bunch of managers, and have seen hundreds and hundreds of portfolios over the years that are supposed to be market neutral. So when things happen with inside factors where growth, momentum, all these things are going on, it ends up having a lot of problems that are taking things down. So leverage is coming down. I completely agree. Over-levered people are taking stuff down, and that's leading to a lot of trades. This is really important and something I can't recommend enough to start thinking about. We've been in a very concentrated market since COVID. Concentrated not just in terms of the stocks that have worked, but in terms of companies that are actually seeing earnings revisions. You still have negative year-over-year earnings for the Russell 2000 in the fourth quarter of last year. You've had negative earnings growth for Europe. There hasn't been a lot of companies that have been able to have a part of the 3-month EPS revision factor. This is just the long side only. This has been the market. So this red line here is that factor. 3-month revisions, they have come down sharply in a multiple standard deviation move, and the S&P has followed it. This is what hedge funds are long. Absolutely no doubt about it, and it has an impact on all hedge fund returns. So this chart here, red line, again, is that same 3-month earnings per share revision. So again, this is going to be the companies that are having the highest 3-month earnings revisions. So they've now come down the sharpest. So think of them as the best fundamental companies, which generally means they're going to have high multiples. Think of this as Palantir. Think of this as Salesforce. Think of this as any of the companies that you've seen fall sharply recently, any of them. Most of them have good earnings revisions. The green line here is the Bloomberg All Hedge Fund Index. You can see how correlated these are. Now, this is updated every month. This does not just include equities. This includes multi-strats. So it's long short equities. It's multi-strats. It's credit, merger arb, risk arb, every single thing you can think of. With this coming down, I would expect to see this go. Because remember, the equity books generally at the multi-strats are the largest. When they start deleveraging, it spreads throughout the other market neutral things, and you start to see all hedge fund books come down. You start to see macro get hit. So I think we're in an unwinding phase, and one of the reasons is this one is even more important. So this is the long short market neutral 3-month reversion factor. The reason this one's important, this move here, which effectively is about a 7% move, you got to think about it from since I guess over the last year, we just gave back more than half of this in a very short amount of time. This is the thing that causes leverage. So that thing that was a multiple standard deviation move. And basically what ended up going on when you go through this, I went through this and said, what's the recent drawdown? And this is going back now even further. So I took this back. And I put it into Grok, and I had Grok go through it. And this is the worst drawdown now of 11.7% from the peak of this entire move since 2015. So this one here, it's bigger than this one in terms of over the period, 26 days. This was COVID. This is a very large move, and it comes at a time where leverage is at highs. So leverage was not as high back then as it is now. This is the Goldman Sachs Hedge Fund VIP basket, which means the most owned hedge fund names, and this is it relative to the S&P. So I look at this relative to the S&P. This was the worst week since 2008. And what I put in Twitter, which is really important, back here when this happened, the VIX was 80. This happened before this week started. The VIX was right around 20. 4 times the volatility back here than it was here, which means this is a scary one in terms of how much people were not prepared for it, how much leverage they had on. There was less leverage here, more leverage here, similar moves. So we'll see what happens, but I think in the month of March, we've seen significant damage. Zero Hedge put this out, biggest thematic drawdowns in years. Goldman Sachs High Momentum Long. The hedge fund VIP, which I just showed you. Middle income consumer, which is an important one, the biggest. The momentum pairs. You're just having a lot of unwinds happening. We've seen an unprecedented de-risking from hedge funds during the S&P pullback. This was from Goldman Sachs. Again, this was March 6th. So this was in the middle of the week. Does not include the Thursday. Gross leverage. This is from the peak. So in the peak of when that earnings revisions factor started to roll over, it's exactly at the time period around February 18th for the market neutral one. So from February 18th, the 100th percentile of 3-year in terms of the leverage. So that's what I'm saying. And again, current 5-year, 100. The gross was enormous. Even the net was large, but this is the one that I really care about in terms of the gross number. Warren Buffett quote, what does the saying, when the tide goes out, you begin to find out who's naked mean? This is really important, and this is why I'm saying I don't know how much further this is going to extend, but when you have the government saying they're willing to shift the market into a recession, Germany spends money, so you get this massive correlation break where everyone needs to reassess that U.S. exceptionalism, which they were positioned for well over a decade into 15 years, is not working. The Mag 7 are down 18% from the highs, while the DAX is up close to 15%. These are massive divergences, and they're costing people or causing people to move. But you also have hedge funds face new watchdog scrutiny. This was back on February 25th. I didn't bring this up, but whether it's the basis trade, the carry trade, they were still going through this. Their talk is that there's a problem. Hedge funds at the end of the month were trying to fight back. That's all well and good, but when you start having losses pile up, it starts to become an issue. This is in today's FT on Saturday. Hedge fund leverage is rising as a concern for regulators. It goes through this, and remember, this is not including the losses that have gone on. According to the U.S. Office of Financial Research, hedge fund borrowing in so-called repo markets has increased by 1.5 trillion since the end of 2020, almost $1 trillion of which is accounted for solely the largest 10 funds. This is the issue, is that these largest funds are the ones with the most complicated book, depending on risk management, depending on correlations of other assets. And as of now, this has primarily been a long-short equity thing with some macro stuff that I showed on the bunds. But this stuff starts, and it usually continues to go. Hedge funds give up half of their 2025 gains in challenging markets, says Goldman Sachs. This was on Friday. So again, when losses start to pile up, it starts to become an issue. They also have another issue, and I've talked about this. AI is now ubiquitous. It is now free. It is now open source. You can go in and backtest anything. I use Grok all day long. I use Perplexity all day long to look at markets. You can go in and have a backtested thing that has worked for the last 5 years, whatever you want, very easily. You just have to upload the data. The problem is that means everyone ends up in the same trades. So you've got a situation that to survive, as this quant said, funds must adopt AI to survive after DeepSeek. I take it very differently. I think there's just too much competition, and AI is disrupting risk management more so than returns. I think it helps the momentum side, that it feeds to everyone to be in the same trades. But when this stuff starts to not work, the risk management stuff becomes the issue. And I think it is false, not working risk management that's going to be the issue. And everyone knows what they should get out of based on using AI. AI startups are happening. I've talked to 3 different ones over the last month asking my opinion because of my Visser Labs consulting model. They all are leaving existing quant strategies, and their ideas are very, very good, and they're all using Gen AI. So this is just going to be more competition. So I think the hedge fund world is coming into a very big shift with Trump in office, a shift towards Bitcoin, Main Street versus Wall Street. There's just a very big problem that's going on, and the regulators are looking into it. And so if anything happens to force the regulators to look closer because there's losses, this is just the kind of stuff that you have to watch. So I'll be talking about this a lot. Like I said, I think the market and the hedge funds have probably had enough deleveraging for now. I will start to go through what you have to look for to see if this is becoming a bigger issue. In terms of just highlighting both the earnings and the economy and why this is such a big issue, in the FactSet earnings day, lowest number of S&P 500's companies citing recession in over 5 years on the calls. So they're not talking about a recession. There's no recession. But at the same time, every single earnings per share for this year is being lowered across every single sector. So we've already had a big drop off. And the reason why? On the same thing, S&P 500 companies citing tariffs through the roof. So half of the companies are talking about how tariffs are an impact. Wall Street banks say markets are flashing rising recession risk. No question recession risk is rising. The government has said they don't care about growth right now. Trump tariff uncertainty overshadows growth promises. Wall Street worries Trump tariffs could wreck the souring economy. Is the White House trying to engineer a recession? This is a commentary out there that very, very large managers are calling me saying they believe. BCA, the first one to come out and say we're on a recession watch. This is from Torsten Slok. Biggest downside risk is policy uncertainty could create a sudden stop in the economy where consumers stop buying cars, stop going to restaurants, all the data we've seen so far in this quarter, which has taken the GDP now down to minus 2.8%, the data has all highlighted that the consumer is pausing on stuff. That doesn't mean we're going to have a recession. We don't have large job losses. The job market was fine. But this economy, as I said, is very dependent on the stock market. So I think the White House is trying to do something that is going to be a very, very tough needle to thread. I just think it's going to be tough because of the stock market being 200% of GDP. You tell me if you've heard that. I follow it all the time, and every time I talk to someone, I did on our the Pompliano podcast for this week, where I brought it up repeatedly. This is a very dangerous game when the stock market is this important. This is from Torsten Slok again. Vacation intended in the U.S. within 6 months. Complete breakdown. Look at it. I mean, the only thing you see on record, anything comparable to this, is right here. You can't even see in a big way 9/11. So people are just confused over what the policy is. Goldman Sachs updating their forecast, higher inflation, less growth. So that's the stagflation side. Higher unemployment, higher recession odds. Everything going against it. And I would agree that all of those have to be your baseline forecast of what's going to happen, as long as the government is saying what they're saying and everyone is saying tariffs are coming. JP Morgan, they're not wavering on the U.S. expansion. Same thing I believe. However, we are becoming more concerned that U.S. policy actions will weigh on demand and damage sentiment in a manner that shakes the foundation of the expansion. Completely agree. They say they want that. The Beige Book came out this week. Here is what Perplexity had on it. Business sentiment remained cautiously optimistic, but there was growing uncertainty surrounding new policies, particularly regarding the tariffs. A slight downtick in activity. Consumer spending weakened, and there was increased caution among businesses due to policy uncertainty. The labor market shows signs of easing with improved slighter wage growth. Basically, the economy is weakening. It was already weakening ahead of time. JP Morgan on Doge, unlike the Clinton cuts, it was 450,000 jobs over 8 years. They're trying to get more done faster. Part of this is because of the midterms. So they are willing to sacrifice Reagan style. That's what I keep hearing. They're willing to tank the economy. In the case of Reagan, it was through Volcker raising rates dramatically to hurt it. Reagan said, go ahead and do it. We got to kill inflation. This time it's very different. The unemployment rate is 4% and CPI is around 3%. So now we're trying to cut a lot of jobs when the economy is weakening and the stock market is so important. I just don't know how that's going to work. I did want to bring this up. The job report on Friday was good. It wasn't great, and I still believe, like I've said, that the AI impact is starting to show up. What I want to highlight here is I've broken the jobs market into two separate categories. So there's 145 or 150 million jobs. You can see that I break it down into two separate categories here. This orange line here is what I call non-cyclical jobs. Non-cyclical jobs are the ones that have been going up regardless of what was going on in the economy, other than the shutdown, meaning it is continuously been going over. The cyclical one is the one that has driven the economy over time when we have recessions. The reason I say we can't have a recession is because of this line is becoming a much bigger portion. This is leisure and activity. So this is for the baby boomers and travel. This one there is some sensitivity to, but we've had a labor shortage there, so it continues to grow. We're still building hotels. We're still doing cruise ships, so that continues to grow. You have healthcare and teachers. We continually need to hire teachers because we have people that are retiring, not getting fired. So the replacement side on the teachers is there. Healthcare, we need more nurses. People are sick. It continues. But the other one that's in here is the government. So if the government isn't hiring the way they were, you're going to start to see the slowdown. That is exactly what we've seen, is it's starting to roll over a little bit. This one is effectively unchanged since 2022. People haven't really noticed this. There's been very little job growth on everything else. And so if we see the job stuff in the government come down, I do think we're going to head towards zero with the combination of AI, the government jobs, and the fact that the tariffs are actually deflationary. Jared Dillian put this out back on March 4th, and he wrote about them being deflationary, recommended a book to read, and I completely agree. Pompliano and I talked about it as them being deflationary. It is inflationary day one. It's stagflationary overall. But if you're intending to get the stock market lower, and that's your goal, that means he's going to put these tariffs through, and he's sacrificing the stock market. That becomes deflationary more so than inflationary, and that's what we're seeing in asset markets, at least for the stuff for the United States. Is he willing to go far? The reason I've said I didn't think he will go all the way, and he still hasn't at this point, is the approval ratings are starting to weaken. So how much can he handle personally? How much can he handle for the midterms? He's coming under more pressure. So we'll see what happens. If he changes at any point, I think the market will rally significantly. I think this is all uncertainty at this point. There's nothing structural. But if the S&P continues to break lower, you will start to see more cries for a recession, and it'll become a self-fulfilling prophecy. Technically, we hit a very big level. This is why I think we're going to get a bounce. I wouldn't even be surprised to see the bounce come all the way up to 6,000, which would be a significant bounce from where we are. That's a 3 to 4% bounce. So I would not be surprised, purely based on the fact that I think people want to come in and buy, and that's because sentiment has gotten completely overdone. So we've talked about the AII, we've talked about other ones. This one, by far, I don't pay for Ned Davis anymore. This one was always the best one to me because it's so broad as a composite. This thing hit down to an extremely low level, and this is usually a very good sign in terms of going through it. So Ned Davis got down to a very good buy signal. The CNN fear and greed index hit the lowest since August, so you've come down on that one as well. The Russell 2000, in terms of percentage of names greater than the 50-day moving average, has completely come down. This is the 10-day moving average, which is back at the lows here. So the Russell IWM has been down 6 weeks in a row. We're oversold. And the other reason I would expect to bounce, and this is going to be the most important thing going forward. So this here reflects another big move down in terms of the factors. This one here is going to be beta over profitability. So beta collapsed relative to profitability. Every time we've kind of had one of these moves, we made a low in the market since really 2022. And the reason has been that credit spreads have continually tightened. So this is junk spreads. You can see, and this is inverted, they've started to widen. This is the critical thing. If we're really getting worried about the recession, then you're going to start to see junk spreads widen. That has not happened yet. Here is LQD relative to IEF. This is a good one to use for you guys looking for real-time data. LQD is the investment grade ETF. IEF is the government one. This kind of gives you a spread. During COVID, you can see how this one collapsed. Same thing during the great financial crisis. When people are having trouble with credit, especially multi-strats who need to sell, you will start to see this thing accelerate. This is a very critical thing to watch. It started to weaken last week. I think this will be the one because this is where you get liquidity in the credit markets if you need to hedge up your book. So LQD versus IEF. IG has not budged yet. It's gradually moving out. This is IG CDX. This here is the European Bank Senior CDX, still sitting at the lows. If we get anything here that's important for multi-strats, you'll start to see it spread a little bit around the globe. We're not there yet. EU banks, I put this out on X this week. The white line here is EU banks. Amazing trend. As long as this is going on, Bitcoin is in good shape. This is the overlay with Bitcoin over this. So I do think that eventually when we get the bounce in the US, you're going to see Bitcoin very quickly go up to the all-time highs. So once we get a bounce in US stocks, I think it's going to have an impact on Bitcoin. And the reason is because I don't see a recession showing up anywhere. This is another signal that's positive. Copper. If we were really going into something worry of a recession, the market, then copper would be headed down. Copper looks great here. It looks like a reverse head and shoulders ready to break out. This is the PMI. I think the US PMI is going to sit around here because of the tariffs, but copper is saying that Europe and China in particular are strong. China announced some more stimulus measures this week as well. Their stock market's doing well. Breadth, another reason right now that is not a problem. I did want to highlight this chart. So S&P breadth, this doesn't include Friday, is basically at the all-time highs. The price movements come down, so there's been a rotation. That's what this means. We saw this in August, during the August period too, where the S&P came down sharply while the breadth went sideways. This move here in the S&P is what I think, when we actually have a move lower in the S&P, if we have another leg and it goes down to that area I talked about in kind of the 5,200 to 5,500 area, I believe it'll be a 3-day flush or a 1-day flush as part of a hedge fund unwind. I don't think it's going to be because of a recession. And remember, the market I never thought was that expensive because of profit margins. We're only down 2% year to date, so it's not like it's some major problem. But I do think we'd have to see a flush with the vol expanding more than it has so far, but I think it bounced first. Mag 7, we now got to a 19% drawdown. We hit the 200-day moving average and closed below it. The last time we closed below it was here, and you can see what happened. We got a bounce. This looks very similar to this. I've mentioned and I've shown this area because this is where, if we look at the tips market in terms of the swap break-even curve, inflation is still going higher. So we're still seeing inflation expectations within 2 years as being high. 10-year inflation expectations are coming down. So we still have a problem right now where the curve is still showing that inflation expectations in the short term are still going higher. And as that is the case, I don't think we're going to see this kind of move, but I do think the Mag 7 is going to have trouble on a relative basis if that goes on. Mag 7, this is a monthly MACD, and this is why I think last time we got a monthly MACD crossover, we're close to it now. It'll probably happen not this month, but maybe next month. Remember, we're in the middle of a month now. Last time that led to a decline. I think this is going to be a period of time where this needs to work off the excesses that's in there. Global money supply, the white line here, just made a new high. So we had this move lower. This has been driven by continuous growth in M2 for US, now Europe, and China, but also because the dollar is weakening. So you've gone back to the highs. The gold, this is the gold chart, direct overlay, pretty good with it. Normally Bitcoin goes with it. Bitcoin has obviously been in here because Bitcoin is not just global liquidity. I always like to say Bitcoin is more like the S&P 500. It's about 30% global liquidity, 70% technology at this point. This is going to go higher at this point, and this will be the time where people start to realize that this is the purest AI trade, as I've said repeatedly. I will keep saying it. Here's the chart of Bitcoin relative to the Mag 7. Great looking chart. I've highlighted that until you get to these points where it gets overdone, these were both peaks in Bitcoin. We got a long way to go here, people. I expect a significant move higher in Bitcoin over the rest of the year because I don't see a recession in the U.S., and I think we're going to start cutting rates. The dollar is weakening already, and I think that what they're doing is going to lead to a stock market fall, not a crash, a fall. And if that happens, I think they're going to have to lower rates. And I think Bitcoin, once it breaks back higher on a bounce, I think it'll be sitting in a good position. Another thing that has historically done very well as a trigger point for Bitcoin, the euro had its largest weekly advance over the last 5 years. It happened here, a similar type move. Here was Bitcoin, and then Bitcoin went higher. Then we had this one here. Bitcoin bottomed, and then it went higher. There's a reason. Europe is the caboose of liquidity. They have the tightest purse strings. When they're willing to print as well, the U.S., it does not take much for us to print. Big week. We finally signed the EO to establish a government Bitcoin reserve. Like I said, people, I think, wanted them to buy stuff, but that's not the way this is going to work, at least in not announcing it. They had a digital asset summit at the White House. And I think most important is just the messages. I promise to make America the Bitcoin superpower of the world, and we're taking historic action to deliver on that promise. Why don't people pay attention to what's happening in the stock market? He doesn't want the stock market to go higher, but he does want crypto to go higher. You should be long Bitcoin, and you should be short Mag 7. That's the trade going forward. And he connects AI to Bitcoin. He has an AI and crypto czar. They are connected. I will keep saying it. And if you watch Anthony Pompliano, I'll keep driving home in there. I have some other data on that as we go forward. But Lutnick put this up. Technology is at the foundation of the Trump presidency. Again, crypto is an important part of what they're trying to do with the blockchain in there. One of the Winklevoss twins was at the summit. Today's Digital Asset Summit made one thing crystal clear. The Trump administration is just getting started, making America the most pro-crypto country in the world. They're moving at the speed of a technology startup. The strategic Bitcoin reserve and stockpile are not the end, but just the beginning. I don't know why people just can't embrace it at this point, but they will. No need to bring Bitcoin onshore, or they need to bring Bitcoin onshore. We'll see what goes forward in any acquisition. But both him and Sachs were out saying, just highlighting that the government, the previous administration was selling it, and the first thing they're going to do is stop selling it. This was one of the important stories that came out of the summit, and I'll tell you why. Stablecoins will preserve dollar dominance. I've talked about stablecoins on this. More importantly, I just wrote something about it on Monday before the summit. Andreessen's Bitcoin bet, unleashing AI and stablecoins in a digital economy. Everyone who wants to either learn about the digital economy and what it's going to look like, or is a Bitcoin and crypto lover, you have to read Stripe's 2024 annual letter. That's what that Substack was about. I go through the interconnection of AI agents, and stablecoins, and the growth in the ecosystem. Bitcoin benefits the second that people around the globe and startups decide to use Stripe and decide to use stablecoin for their transactions for lower costs, faster transactions. Every time a dollar is there, that means someone opens up a wallet, they have more access into the crypto world, the digital economy, and Bitcoin is the bank of that world. That's where you put your money for store of value. Every single time a transaction goes on in stablecoins, it leads to a better ecosystem. They have been correlated in terms of the market cap of Bitcoin and the market cap of stablecoins. You have to spend the time. I've talked to you about the Treasury Borrowing Advisory Committee in terms of going through it. The government is saying they want stablecoins to help preserve the dollar. Stripe is talking about the volumes that they're seeing and how quickly AI startups are growing. This is a global phenomena that will continue to go. And outside the US, in countries like where I used to live, Brazil, you're starting to see more of this. This is a global thing. This is not a US only situation. And that's the thing you have to remember. Bitcoin is not some speculative thing where I see Peter Schiff and these idiots talking about it in some way that it doesn't mean anything when it's happening around the globe. So you can disagree and not believe that it's as good as gold, but to say it has no value and it's a scam and there's no reason the government should be involved in it, it's just, I mean, literally, it's just being old. And that guy on the chair on the in front of the house yelling at the kids. Bhutan, how it's helped their finance their nation's expenses. Again, these are poor countries. Brazil, Bhutan, El Salvador, the IMF, telling them, okay, we'll give you money. Bukele took the money, then he bought more Bitcoin, but only if you stop buying Bitcoin. You just can't stop this. This is a moat for the digital economy. Belarus going through it. That's it for me this week. Like I said, I'm happy to be working with 22V. You can go reach out to them directly. You can reach out to me. I'll be doing a lot of research for them during the week as well. So if you're interested in trading with them, doing stuff with them, I'll be doing a lot of different research with them. And then watch Anthony Pompliano and I will be going through everything from both a macro and a crypto perspective. Thanks, and I'll see you guys next week.